Hey, hello, this is Martin from Sickets, the channel for learning about trading and investing. Welcome to Markets Next Week, the weekly stock market analysis show. That's for the week that's beginning from tomorrow, June 26th, Monday 2022. So, as we usually do, we will be looking at what happened in the market during the last week with the help of technical analysis, learn something from it, and plan for a better trade for the upcoming week. That's what we do. So let's get into the charts right away. Here we have the weekly charts of the Nifty that you see on the left side and the Banknifty on the right side. That's definitely a bull trap that you see there. Wide range bearish candle, and it is also known as a dark cloud cover when it is more than 50% of the previous bullish candle. So the market is in an up move, suddenly trapped the bulls and then pulls back heavily. That's when the dark cloud comes. That's the beginning. That could be the beginning of a bearish trend if it is confirmed by a move below the candle's low. That's what. So clear bearishness indicated on the charts of the weekly charts of the Nifty, and the Bank Nifty has been weak since last several weeks. Look at the red candles it's formed since the last 4 weeks, and then it continued the consolidation and formed a bearish, wide range bearish candle with a small bounce up at the support zone. That's what happened with weekly charts of the Bank Nifty, as you see here. Moving on, before that, let's look at another view. So this is what we have. We have a flag formation on the weekly charts on the Nifty, and a flag formation clearly visible on the Bank Nifty as well. And it had broken out. Both of that had broken out. And we also have a cup pattern on the Nifty, and right side you have a cup and a handle pattern. Both are powerful on the medium term charts, and all of these three patterns had the breakout that had happened, but it seems like it is not sustaining. Look at this on the left side on the Nifty charts on the weekly. This is a rounding pattern which is confirmed with a green candle breaking out of that, but failed to sustain that. Similarly, look at this. It's a breakout of the flag confirmed, the breakout of the cup and handle confirmed, but it seems to be consolidating and then not completely doing another breakout from that previous all-time high. So that's what we are. So it's at a crucial zone, still at a crucial zone, a crucial breakout zone, which is almost confirmed to have broken out. And remember that we were at just 1 point or less from the all-time high being hit on the Nifty. Bank Nifty had already made the all-time high weeks back, but Nifty just was inches before that. Just inches before that. You can see that from the charts. That's what happens when everyone was anticipating a breakout for sure and an all-time high for sure, double sure. But that's what market surprises when all of the participants, majority of the participants are on one side, market gives surprises the other way. That's what happened. Now look at the daily charts. Right? We can from the daily charts you can see what was the price action on the last 3 weeks. So it was an attempt to move up and then fall out. It's a V-shaped move that we can clearly see. We just trapped the bulls. That's what happened with the Nifty trap. A V-shaped, inverted V actually, not a V. It's an inverted V, a reversal that has happened on the Bank Nifty, trapping the bulls. And Bank Nifty, basically you can see that it is still consolidating before the previous that wide range bearish candle. So Bank Nifty has been consolidating for the last 4, 5, 6 days within that candle. Right, from Friday it is consolidating, has begun, and then still within that. It has not gone outside that, neither has gone out, outside on both sides. So it has not happened. So Bank Nifty clearly indicate you of consolidation that's happening on daily charts, and also you can see that this is a support zone for sure. So there is a probability of a bounce up from here because this support is a previous breakout zone. The previous resistance is acting as a support. That is what change in polarity, bounce up possibilities. So it's not confirmed until the price moves above this candle's high. Similarly, Bank Nifty also is on a support zone, major support zone. Only if we have this support that you see here is breached, only then we have things to worry about. But otherwise the daily charts on the indices are showing bearishness. There is indecisiveness also, with a very thin, doji that is formed on the Banknifty daily charts, and a wide range bearish at taking a support, is what you can see. Also, you can see that the 20 DEMA exponential moving average is still not breached on Banknifty, so it's a double confirmation of a support. Previous the probability possibility is still there. Banknifty has already breached previous week itself, the 20. Not previous week, Friday itself, I think the DEMA is breached and taken support of 50 exponential moving average. So, Banknifty breaching 20 DEMA is okay, but Nifty is still taking the support, so then the trend is intact and it's moving up. And if it falls from here downside, it could, it could be trouble, is what it indicates. So let's look at the Bollinger Bands. That indicates that the Nifty, which was expanding on the upside, indicating up move, is now turned to be consolidating and contracting, and which indicates there is some sideways price action that could be expected, and it is a bullish bias because it's slightly above the moving average. So that's what. So Banknifty is already in the consolidation mode, and the expansion the downside also had begun, but it is not confirmed as it has not gone below the previous swing low. So it's consolidation that's confirmed, seen, and the beginning of consolidation that is seen on the Nifty, right? So that is what we are. So sideways price action is what the charts are saying. Look at the support resistance. So first resistance on the upside would be the all-time high, 18,887, right? And there's a small gap is there. It's very small. You can ignore that. And after that, 19,000 would be the resistance after that. Downside, so before that, 18,700 would be crucial resistance on the upside. So 18,700, 18,800, 18,890, that's all-time high, and the 19,000 resistance after. Downside, you have the 20 moving exponential average of 18,650 would be 640 would be a good support, and if that is breached, then you have 18,614, 18,600 rounding number, 18,473 would be the previous swing lows, and after that you have 50 moving average, 18,360. That's also, then it goes to 18,300 zones, 18,200 zones. These are all swing lows, and then finally to the 18,060 zones. So exponential moving average is at 17,850, right? So that's how the support resistances are seen on the charts as of now, based on previous support zones and the moving averages, and same thing can be seen on the Banknifty support resistance zones. The first resistance would be on the upside to take out the 20 exponential moving average, which is at 43,800, and 44,000 rounding number has been taken out. Then you have the previous swing lows at 40, swing highs at 44,151, then 44,500 nearby zones. That's all-time high zones. That's how it rests in the upside. And supports will be to maintain the previous swing low as 43,600 has been maintained first, and then that bridges then 43,600 has been made, then 43,367, then 43,322, then 43,000 rounding number, and 42,583 is a 100 exponential moving average. 50 exponential moving average support is also near the 43,600 nearby zone. So it's downside, 42,000 would be the next swing low, and then 41,671. So that's how it is. So it's a cup and handle pattern also seen on the Banknifty. So if it does not break this 43,600 zones and that swing lows, and then that support is maintained, then there is a possibility that it can break out big time. Cup and handle pattern. Banknifty does not have a cup and handle, it's surrounding cup pattern only. On daily charts we talk about. So that's the support resistances that you can see on the Banknifty. Let's move ahead and see the momentum and the trend. How does it perform? So you can clearly see that the momentum has slipped to the sideways on the short term on both indices, and sideways and falling momentum is what you can see. But long term momentum is intact. It's bullish, but it's falling. We are analyzing the momentum with the help of RSI, and the trend indicator we are using the ADX trend indicator. So ADX is showing that we have the ADX is the strength of that trend is falling, but ADX is still bullish on the medium term weekly charts we talk about. But the daily charts, it's slipped to the bearish zones and it's falling momentum on the Nifty, and it's rising, slightly rising, but bearish zones. Negative zones is what Banknifty momentum also in the short term is, right? So momentum and the trend is slipped into the negative zones of both indices. That's what you can see. But in turn, it still has to breach that and it remains fine. Volatility and opportunity analysis. The next one, volatility. If you're we already measured that to some extent on the volatility bands. Now, India VIX has spiked 3.7% last week when the market fell down, reverted back, pulled back. So 3.7%. That's 11.233. Can you imagine that we had been in this 11-12 range for a very long time? At the same time, the volatility within this 11-12 range, historic low volatility range, has been very, very huge. That is a speciality that we could see because of some market cycle changes that has happened. Despite having a very low VIX, we have very high volatility intraday. That's why it's difficult to trade for the options. So this is a dynamic change in behavior of the market as per the time cycles. So that is something that will be kept in mind. Although the fear in the market is less, but volatility, high volatile spikes are happening, and we end up having expiry days having very low. Even otherwise, we have very low premiums to play with, and in addition to this high volatile spikes ups and spike downs, that happen at this level, it's getting tough. We have to be cautious also, and whenever VIX is at very low level, there is a probability of big spikes that could come up, which could wipe out your capital. So you have to be cautious with respect to its behavior. But premiums could rise up sporadically, and for non-rational traders and option sellers and all that, could be finding it very difficult to manage when it happens suddenly. So be cautious at this lower levels. And this peculiar behavior of the market that we are seeing since last several months now, beginning of 2023 onwards, probably maybe before that as well, right? A few months before that as well. So it's bearishness that you can see on the futures open interest. It's a long unwinding build-up that you can see on the Nifty, and it's short build-up that you see in the Banknifty. So futures OIA is saying it's bearish. Open interest is not bearish for the 29 monthly expiry. It's definitely going to be volatile when monthly expiries are happening. So put call ratio is not bearish, 0.81 and 0.84 on Nifty and Bank respectively. It's not bullish enough, you have to say. If it was above 1, because it's sold, it is bullish, but it's not bullish enough. Neither is it bearish. This is the open interest analysis for the Nifty and the Bank Nifty that you're seeing. Simple resistances all over there, but Bank Nifty has got a huge support that you can see there, 43,500 zones. So 43,000 zones. So that's where the highest. So the highest support. So the put rating is seen at 18,800 still, few days from the expiry of the monthly. And the highest resistance is also seen at 18,800. So 18,800 triangle is what the option writers are still betting on. That's why we have 0.81 and not a very low PCR put call ratio that we have. So 18,800 is what the highest put and call rating is seen at. Now look at the range. 18,000 and 19,000 is the second level of the option writing, highest put and call writing. That means, if that 18,000 triangle doesn't work out, there will be huge long unwinding that will happen, and then it will be a big fall that can happen if that failed to sustain by the end of the month. That's what the options are like showing. Banknifty, look at this, it's 43,000 and 44,000. It's very narrow range there on the Banknifty where the highest put and call rating is seen. 43,500 and 45,000 weight range. They are also where the highest, second level of highest put and call rating is seen. Right? Put call ratings, we have seen that it is not bearish yet, but it's neither bullish also, but not bullish enough is what we would say. So bearish futures OI build up, we already seen that. So it's a mixed bag. Right? As of now, options data is not giving very clear picture. It's just saying that there is a very narrow range trying to change options better. Option traders are also on the fence. Right? If something breaks at that 18,800 does not work out next week and 43,000 is breached, then we have big trouble that may come in. And if that sustains, then we may have the possibility of all-time high to be hit for the next week. That's how it is. So it's unpredictable kind of scenario as per the options data that it's showing. Overall, futures wise is clearly bearish built up on Friday. Options wise is showing it's not bullish enough. Neither is it bearish kind of build up that has happened on the options wise for the monthly expiries that happening on this Thursday. And next week is a shorter week also. The decay would be faster. Wednesday is some holiday on the NSE. So that's it. Now, having seen the II and volatility, week's momentum, trend, price patterns, and all, let's jump into how the sectors have performed. So here, interestingly, we had a cross sector bullish breakout that had happened. A lot of the sector except one or two, major sectors around broken out and then got into the bullish zones on both time frames of weekly and daily. But unfortunately, we are seeing that has gone up. It's all down more than has happened last week across the sector fall. 0.13% down on IT, metal 3.2% down, auto 1.5% down, pharma 0.42% down, FMCG 2.25% down, and 2% down on the reality. So across the sector fall is what we can see. And right now we have the bullishness that is maintained only in the pharma sector, which maintains the bullish momentum on both time frames on the weekly and daily. Others are all given away the short-term momentum to sideways, and some of them has given us the long-term, medium-term momentum also to the sideways. So that is the picture that we are getting here. So we have to have some of the sectors that's driving and leading that has to emerge out the next week for in order to have any bullishness on the bearishness confirmed. So the hopeful thing is that what gives hope to the bulls is the fact that none of them have turned into bear zones yet. It's still sideways. So as the charts of the index indicates, it's consolidation and not heavy bearishness yet seen across the sector. You can see this charts also the same, indicating IT is showing that it is having a momentum that is sideways, and that is going on since long. Metal also has met with the resistance and fallen down. It was moving up steadily when it got hit at the moment of resistance, and things have changed. Auto is breaking out and still bullish on the long term, and hit the resistance and then reverted. But more is still bullish. Pharma is more or less still bullish, but it also faced the heat of the resistance last week. FMCG also has broken out of the channel almost with the resistance, although it's still bullish on the medium terms, but the trend has taken a bend. Reality is also in the bullish zone, so you can see that the FMCG, the reality, the auto, the pharma, these are the four sectors that are driving the market. They're all bullish still in the momentum perspective from the medium terms, but the short term they all got hit back last week. And the hit back was so bad that it had slipped in the sideways on the daily. And others two sectors, the IT and the metal, were the sideways and trying to rise up and more, but got hit and then fell prey to the resistance. That's what we are seeing here. Now moving on, if you try to analyze the major heavyweight stocks that contribute maximum to the index, HDFC and HDFC Bank, they are having some kind of major merger related things that's happening, a lot of volatility, and it's unable to trade on that unless you're a long-term investor or something. But the momentum is still sideways and rising up, and consolidation is what is happening, and in a very crucial bear zones. So just have to focus of short-term trading in this. That's absolutely impossible. Reliance also is consolidating, and it was trying to break out and move up to the bullish zones in the medium term, but got hit at the momentum RSI 60 and then fell down. That's what has happened. So all of them sideways, and the other heavyweights, the IT stocks, NV and TCS, so both of them are in the sideways since long, and then it's maintaining that. Right? ICICI Bank was in the bullish zones, had broken out, now slipped into the sideways now. It had met with a rounding pattern, a breakout, and all-time high inches. From there, since the last 4 weeks, it is resisting, and the moment is falling, dipped, and then dipped in the sideways now. Kotak Bank had big breakout moves, but failed again, fell for the last 3-4 weeks, down and the sideways and falling. So absolutely not a single heavyweight is in the bullish zones as of now. That's the scenario. Banks, you have three banks here, all three banks, HDFC, Kodak and ICICI, all are in the sideways now. Momentum. Reliance was alone making the big moves last week, but that also has got into resistance and gone sideways, and we have non-leaders in the heavyweight. So so that's where the trouble lies. We have to be cautious on the fact that none of the heavyweights are having bullish momentum. So unless and until the major contributors to the index moves into the bullish zones and then consistently up, so nothing will happen unless that happens. So you have to wait for one or two or three of these 6 or 7 major heavyweights to lead the rally. If that's not happening, things would be sideways. Institutional participation, big buying and big selling is what mixed back what happened in the Fyers side last week. Net they ended up buying 2 crores or something hardly, but because they bought 4,000 crores of buying. Some of it might be because of some HDFC MC buying something. So buying so Fyers are net buyers since several weeks now, which is what is holding, and if that turns back the other way, then we have trouble. We have seen that the Fyers were buying aggressively in one single day, but otherwise it was majorly selling that happened, which is a concern. Net to net, DI's domestic institutions also ended up being 1,700 crores buying. Net longs were flat actually on the derivative side on institutional participation with regard to that, right? So institutional support was and is holding the market, and then if that goes, then we have trouble. As of now, there is some cause for concern, but last week went by without confirming any big sell-off because it balanced out to be net buying mode for the institutions, as you can see. Moving ahead, the global markets, to be analyzing the global markets, the global commodities, gold, and then currencies. Starting with the currencies, the dollar index is spiked to 0.56%, and remember we had a pullback of 2.7%, and it's 102.86 low. Dollar had breached that neckline and then was slipping down, and then once again bounced up. But otherwise, momentum is sideways and trying to rise up. That's what it is. USD INR currency pair, rupiah remains weak as it is, but small gains, 81.96 is what USD INR is saying. So basically, it's a narrowing wedge. And how beautifully that wedge had worked out. Exactly at the narrow wedge, it formed a hammer and then tried to move up. So it's not ready to fall down further from that. But it has to bring down eventually because it's narrowing. And so probably it may go up one more round up towards the all-time high and then break. So momentum is sideways otherwise. Right. So you have to keep a close watch, like I said last week also, on if the US dollar currency is breaching and having a solid weekly candle below that wedge. Let's narrow it down. Now crude oil is spiking up and then maintaining that level below the 75 kind of levels, right? Below the median of the parallel channel. But it was a small spike up with sideways momentum. Last week what happened was a spike, but it's okay, it's still a relief, right? So basically crude oil moved 1.7% up, 71.58, sideways momentum, still a relief. Gold is cup and handle. Attempted 3 times in the handle part, failed all 3 times to make the all-time high breach. But it's not ready to move down this time, and then holding on, consolidating, waiting for that moment to break out. But momentum is sideways, had to catch up on the medium charts, had to catch up in the bullish zones. Right. Trend is still bullish, not crossed over yet. So gold is still there on the top, consolidating after hitting resistance and a failed attempt to break out. Global markets, US market, if you analyze it, it's mixed back. Dow Jones, the major industrial average index that the US markets are having, has hit resistance on the momentum side, and the price has fallen back to the hedge, the descending wedge from where it gave a clear green breakout, which failed. But look at this Nasdaq and the S&P 500. Both the charts are showing clear breakout of the ascending wedge, and momentum is in the bullish zones is rising. So it's contradicting picture, mixed picture that's having. Dow Jones for some reason is facing resistance, but it almost gave a green breakout earlier, which didn't work out. But the breakout, so breakout is confirmed on both the other two indices of Nasdaq. So probably net to net, it may be having an attempt to break out of that consolidation, break out of that resistance zone that was there since long. Dow Jones 1.7% down, 2.6% up from the S&P 500, 3.8% up from the Nasdaq. So overall, it may be that the market is trying to break out of the resistance. Even the Dow Jones may take some more time to catch up, but we have to be concerned about the fact that it is unable to break. The Dow Jones. You have to keep a close watch on that basically. But otherwise, net to net, you will see some green picture, I would say, on the US markets, which is positive. Now, two actions for the next week. One is about the Airtel long, and you can clearly see that the trend line is very solid, and the consolidation and breakout for the third time. So it's clearly a positional trade probably, and this width and the height of that box can be the target, and then you can trail from there. So it can be positional as well as a short swing trade possibility. Have tight stop loss below the entry candles low, and that will give you reasonable risk reward up to 1:2. Side is life sciences. It's a pharma stock that's also in the long call. So it's a cup and a handle that's broken out. A very wide risk move is what happened last week. So put the stop loss right below that, which is also neckline of the cup and handle, and go for a long trade that could be trailed. But definitely the height of the cup is where the breakout could happen, and then that is a long way. You can move further more than the possible targets that is shown in this charts. So it can be a big move. Good risk reward could be there, and reason for the trade is clearly the bullishness in the momentum and the trend that's seen in the stock. Right. Reason for the Airtel also is that momentum is in the bullish zones above RSI breaking out, and the price patterns are beautiful, and the ADX trend indicator also showing a rising trend on the medium term and the short term charts both. Right. So two long falls for the next week. Now, another actionable for the next week is the payoff for the weekly Nifty options. It's a Batman strategy, but one difference: normally I give completely hedged portions, but this is having some amount of risk. Right? It is not completely hedged. That you can do if there is a breach of this 18,500 that happens. Take cover by buying 18,400, and similarly, if there is a breach at the 18,900 that happens, buy a covered call. Otherwise buy a covered. So buy the hedges on both the sides if there is a breach of the selling point happens. So basically this is a Batman strategy. That's what it's known as. So you're basically selling, you're buying inside hedges. Basically you're selling at some two strikes, which are OTMs, and inside OTMs we're buying as hedges. Inside hedging is what we should do. It gives consistent profit as long as market remains in this very wide range. And if the market spikes up, as long as it does not breach this top selling point of 18,550, 18,500 and 18,950, that does not breach, then you can have the maximum profits also at that nearby zones. So hedging is not done on the either sides. Do that in case there is a movement that is happening. Right? It's very limited risk and limited profits also, but it's very consistent. So wide range that we get 18,400 and 19,000. It's not a range that can breach in 1 week's time. I'm not saying it's not possible, but very less probability of that to happen. That's well within the standard deviation range. One standard deviation on the other side, you can clearly see that in the payoff. Right? So that's the Nifty options trading strategy, weekly as well as monthly. This is monthly, so basically we have only 1 week left. So that's it. That's probability of profit also is fair enough. Risk reward, he has to exit before the expiry day on the Wednesday itself, with the 1 or 2% is all that you have to touch. Right? So that's a non-directional. But only thing that is not mentioned here is protecting the big losses if there is big fall or big moves that happen. So if that breach, then immediately buy it and then cover your losses, reduce your losses. That's it. So now that we have seen all of this, let's just wrap up. What happened was the market failing to break out and unable to sustain the Friday big bounce that happened, and eventually it pulled back, and that pullback happened inches from the all-time high, and then finally it ended up to consolidate and drop the pulse. right? And remember, we are in an ongoing rally of 12 to 15%, and we have a cup rounding flag. All these patterns are seen on on the weekly charts, and the very powerful if it all happens. And we are the neckline crucial breakout zone where we are seeing a pullback. So it's a bit confusing and unpredictable kind of juncture. Very crucial breakout zones is where we are. The Fyers are net buying mode, if you see. It has been how it was for the last several weeks now. Low weeks is what we see. US markets are showing green after a long time, and it's attempting to break out. Already breakout has happened a couple of indices, and it's changing polarity, bounce probability is seen on the charts. Open interest is not bearish, and neither is it bullish. So this all gives some hope for the bulls that there's a pullback consolidation that eventually has got to break out. In the short term, you can see that the momentum has slipped after staying a long time in bullish zones. It has slipped in the sideways. Trend also has moved to negative zones on both indices, and Bollinger Bands are now confirmed to be contracting, and across this different industrial sector sell-off is what we saw last week. So it indicates some consolidation may be there. So market view for the next weeks remains to be neutral view with a bearish bias, because the fact that momentum has slipped and some more slip can happen, some more support zone, some consolidation could happen. So it's a neutral view. Sideways consolidation moves what is expected, but there is a bearish bias to that. If at all those levels that we thought the supports are there is breached, it could pull further down to the next support zones, right? So that's something that you keep in mind. Now there is some global cues that could go wrong always. The black swans could happen, Russian fears, inflation, wars, and all these kind of things could negate the view, and then uncertainty could get escalated all of a sudden. Then markets and things could go out of hand. So that cautious always, and the VIX is at a very historic bottom level. So crude oil remains to be fine, but VCRUD is negating all the gains that we get from the crude. Is what it looks like, So, and 18,400, 19,000 is the level that can be looked for the next week for the supports and resistance. In 42,500 and 44,000 is the range. The open interest range, as I already said earlier, the open interest is showing that there is consolidating. There is a very tight, narrow range where the option bets for the monthly expiry of June is seen, and if there is a long unwinding that happens there, then it could be big downfall that could happen. That's what the open interest option status indicates. For 18,000 is where the second highest option writing is there after the highest at 18,800. Right? So that's how it's. But for 18,400 and 19,000 is the levels that the price action is showing, 42,500 and 44,900. So 18,800 above and 44,500 above is where the all-time high levels are there. So that has to be conquered, in a concrete way before we can hope for any breakout rally to happen further from here. Until then, it's just consolidation. Similarly, downside, there are a lot of supports down there. It may not be the crash that we have need, maybe some corrections, pullbacks, and then eventually market will get back is what the view is. So always overnight risk should not be taken, and then hedges has to be taken with vertical spread on direction strategies and all that can be attempted. When the volatility is low, it's risk, relatively less risk for a portion of play. So go for the hedges and then protect your capital. And also quality stocks that we have purchased for investment also can be protected with the hedging strategies. We can have covered calls and strategies and cash secured puts and all that, which will give you rental income and then also give you opportunity to invest in SIP mode. So you can use options for investing as well. So always manage your risk, cut short your portion size if VIX is spiking up above the threshold of near the 20 levels or 15 or 20 levels. Cut short your portion size accordingly. Manage your risk is all that you can do. And always have risk-defined strategies we are carrying forward overnight. And have tight stop loss in intraday if you're applying that. So that's the only thing in your hands. Risk all surprises, no matter what technical analysis they do, the market could surprise you anytime. So manage your risk is all, portion size well is all that is in your hands to do that. So market view next week, neutral view with some bearish bias to it. So that's what it is. I hope this has brought in some clarity in your trade plan for the next week. If it has helped you some way, please consider hitting the like button, put in the comments, and if you're not subscribed, please subscribe right away and also share it to your friends and colleagues. We have very free subscriptions and appreciate the help in this regard. Thanks for watching. Happy trading, happy learning, and please subscribe to our other social media channels, and also if you want to avail Telegram services, paid services, then you can check out the links also for that. And that's it. Thanks for watching. Happy trading, happy learning, happy investing. Bye bye.